AG Member Firms Corporate Finance Podcast Series. Episode 2 by KNAV India and Audit Alliance LLP. Today's podcast is focused on value unlocking in a transaction, M&A best practices, ideal time to raise capital, investor pitches, do's and don'ts. Let's get started.
Welcome everyone to the AG Podcast Series Episode 2, brought to you by Alina Global Member Firms, Audit Alliance LLP, and KNAV India. I'm your host Sumbul Samin, working as Head of Mergers and Acquisition at Audit Alliance LLP. And today I am thrilled to have with us our guest, Vaibhav Manek, who is serving in KNAV India, which is a leading advisory, assurance, and transaction services firm with a truly global approach. Vaibhav Manek is a co-founder at KNAV India, a firm which he co-founded in January 1999. Currently, he's serving as a CEO of KNAV India, a firm which is headquartered out of US and has presence in UK, Canada, Netherlands, Singapore, and Philippines. Vaibhav has served as an EMEA board member for 4 years, and afterwards, he's serving as part of management committee for the APAC region. Today, the topics of our discussion will be about the M&A best practices, what are the value creation ways for the pre and post M&A transactions. Also, we'll be discussing how to deal with investors, family offices, venture capitalists, and private equity firms. Moreover, Vaibhav will be providing us with his valuable experience and practical insights on how to prepare the investor-oriented pitch and what are the do's and don'ts of an investor-oriented pitch. Thank you very much, Vaibhav, for joining in for today. How are you?
Sumbul, thank you very much for having me for this podcast. I'm doing well. And I'm really looking forward to some insightful questions where I can share my experience, and let's make it a nice interactive session.
Thank you very much. Today, our podcast actually divided into 4 sections, as I mentioned. The first one is about value unlocking in a transaction, pre and post M&A. Vaibhav, that's a very important thing because we at times overlook on the value that we can bring in the pre and post M&A transaction. So can you please tell us about most overlooked ways that you think in the value creation before a deal is signed?
No, that's a great question, Sumbul. If we look at it from a management perspective, and then I will look at it from an advisor perspective. And let's say we are a sell-side management team. Let's say there's a deal to either sell a business or even to raise capital. I think one of the first things that I would look at, and which sometimes gets overlooked, is the whole thought process of why is this transaction happening in the first place? The why of it. In the rush of raising capital, in the rush of selling a business, one doesn't spend enough time thinking through who is an ideal buyer or who's an ideal investor. So that's one of the first thing that I would really spend a lot of time on, the why of it. Really be very laser focused. If I'm on the buy side, again, I would focus on the why of it, saying that why am I buying this business? Or if I'm an investor, why am I investing in this business? And Sumbul, as advisors, that should be our role as well, where we should ensure that there is this question of why is very clearly understood from the sellers if we are advising the sell side, and put down on a nice piece of document the whole rationale and the whole theory. So once you get that why question answered, the why of it, then of course there are 2-3 other aspects to kind of make sure we don't overlook. Operational cleanups, if there are any inefficiencies, buyers or investors pay for smooth running ships. They don't like to see surprises. Customer and revenue quality, long-term contracts, customer concentration should be reduced. You don't want to be having a ship that gets rocked if there is a tariff announcement or something that can just change the way the business runs, and there could be an existential crisis. So those are some of the things I would like to be very careful about and bring that on the fore and make sure that it is insulated to some extent. IPs and disputes. How well are the intellectual properties guarded? Are there any disputes in the business? Can that be kind of cleaned up before we get external investors on board or before trying to sell the business? Because remember, ultimately, all of this will have an impact on the valuation. So, I can go on the narrative side, on management depth and all, but I would start with these 3, getting the why clearly answered, and then look at fixing inefficiencies, look at, having proper contracts in place, and IP protection and compliances in terms of no litigation, no reduced litigation.
Correct. That's where really overlooked as when we are working on a sell side mandate. Very right. What do you think, Vaibhav, are the biggest risks that erode value after a transaction, and how can they be mitigated? As you talked about some risks.
See, when you talk about risks, Sumbul, it's all about integration. The fact that the transaction is complete, we're talking about after the transaction, there are risks, and those risks emanate from less diligence, not well thought through integration. So, one is clearly we call it integration risk, and the way to mitigate is have an integration team in place even before the transaction is closed. So, even before we sign, we actually say when we are starting the process of buying a business or investing, that's the time we should have an integration team in place because it presupposes that you're going to run the business. You're going to do a controlled transaction. You'll be in the driver's seat on the Monday morning. Now, in that situation, you can't have a misalignment. You can't have a mismatched culture or tech platforms that don't kind of speak to each other. And therefore, it's so important that you pre plan integration with joint teams. It's a collaborative effort. You do need the assistance of the sell side team. They're going to continue assuming, and so they'll have to play a big role in getting their systems aligned with the buy side tech platforms. When it comes to culture, the integration team definitely should have people with HR expertise. You got to ensure that the culture is understood, and then there's a small, short process, and then a proper process of combining the talent, getting cross pollination, having some of their sell side acquired companies teams over to the parent company which is buying, giving them training, constant learning and development, having senior folks from the buy side, the parent company, over to the factory or the business of the sell side, spend time with them, understand what is real value for them, how have they grown, and then decide the processes and policies. Yes, a lot of it can be done before, but if this is not done well before, these are risks which can erode, confidence, transaction, etc. One other thing is, remember, Sumbul, we're in the business of advising clients to grow their business as well post the transaction. So customer churn should be avoided. Now, clients or customers will get spooked by any changes. So there should be a proper communication that, hey, our business is now part of this larger business or this global business, and it all augurs well. We're still there. The founders may be moving out, the senior team is there. And therefore, communicating early and communicating often and frequent in the process is very important. That right language, the right messaging should happen where the customer should feel confident that despite the transaction, they will be looked after. There'll be no change in the service level, it'll only enhance. That's important because otherwise you may run the risk of losing customers. Then, synergies. Very important that rosy projections, extra projections, something which is not very validated, those should be avoided. They cannot be overestimation because otherwise there'll be non-performance or deemed non-performance doesn't make sense. And I think it always so important that the diligence scope is very tight. It's very tightened. So environmental diligence, tax diligence, legal surprises, they all could be avoided. I think these are some of the risks that can really erode value and one can mitigate with much better planning. I hope that addresses the central part of your question.
Yes, yes. And I think that's where the firms actually lack, most of the firms, that they don't pre-plan and overlook at the risk. And you have very briefly mentioned all of them. Vaibhav, moving on to our second section, which is M&A best practices for the sell-side engagements. Very important for the firms who are actually working on the sell-side mandates. How do you think a seller can position their business to attract top-tier buyers, and we as firm can help them in positioning their business in a best manner?
Again, very interesting question. If I explain this one or answer this one, Sumbul, with practical, experience and how we have seen this panning out across a few countries, I think the first thing is to show scalability. That our business, even after we sell, it is still very scalable. There is amazing growth potential without heavy capital investment. So we are not saying that you invest X million dollars and then we'll grow. Even today, as we speak, the business will grow. It is growing because here is a potential. So there is market access, there's great technology, there's brand. These are some unique competitive advantages already present. The investment or the sale is not going to change it. In fact, it will only accelerate if at all. So that is how the positioning should start. Talk about the growth potential. Second, the whole leadership bench. So there's no one key man. There is a second layer of leadership. There is a third layer of leadership. Even the founders are being bought out and they will continue over a period of time, but ultimately they will all move. The second leadership bench is pretty strong, and therefore it reduces any key man risk. So, which means the processes are institutionalized, not driven by one or two people. It's not a moment for proprietary, business that is getting sold. There are professionals who will help, and that from a buyer point of view, that's a very important thing. How will we run the ship? Especially if it's across an international location and one is not present in that country. This is a very important aspect to note, that there is a leadership bench strength that's available. Then I would look at ESG and governance readiness. I think it's so important, more and more important now to institutional buyers, that there is a proper ESG and governance process in place, which means environmental risks, sustainability, and governance have been thought through. There are teams empowered to kind of execute on that, and they're continuing executing, not just because of the transaction, but even otherwise. And governance readiness is all about taking the right decisions, doing things right when nobody's watching, really kind of ensuring that the business is run the way it should be run. Now, all of this again should be tied up with proper set of financials, audited financials, clean diligence. So when we talk about top tier buyers and institutional buyers, these are the things that they actually want to see. And if you can position that, I think you would have had a very strong chance of moving forward in a transaction. The conclusion will happen if they are convinced about the final business model. But these are some steps that I would look at to position really high quality, top quality institutional buyers.
Great, and very important factors that you have mentioned specifically about ESG, which is highly important these days to look up to. Vaibhav, what due diligence preparation steps over the most time and cost in a sell side process?
Sure. So if you're talking about due diligence preparation steps in a sell side process, I think virtual data room readiness is the first point. Sumbul, one needs to have high quality data room prepared well in advance, even before we approach potential buyers for a transaction, which means, proper indexed, uploaded documents, maintained through the last months. Also, it's a shelf prospectus readiness, which means constant updation of the data room. And then having a vendor diligence done beforehand, that can resolve a lot of the early issues. So there are no surprises when the buy side appoints their diligence advisors and they start their process. Now, this is one important thing, and sometimes sellers don't spend enough time just getting a real diligence readiness and data room. The second is, reconciliations, whether it is financial reconciliations, whether it is inconsistencies across, if there is a global kind of business, it's very critical that the financials all tie up well, the audited, consolidated set of statements are made available. Then if there are any legal issues and there are compliance issues, they should be kind of taken care of ahead of time. It's all pre-cleared, it's all resolved before the buyers discover them. It's important to kind of let them know that, yes, there were so many issues, we've cleaned up, there's one issue or two issue left, here is a resolution. So if you upfrontly bring out, that solves for a lot of time issues. Then, things like if there are sensitive relationships with customers, suppliers, they should be managed well in time. And finally, one should prepare as an advisor. I've prepared the management for some tough questions and prepare answers for that. Have a cheat sheet of 150 questions that the buyers will ask. Keep it ready with data, with references, with sheets, with worksheets and documents, so that when the diligence starts, it's a very quick and efficient diligence because you know what they're going to ask. So having an experienced advisor to manage this process can help if the in-house time or expertise is missing. So that's how I would look at a quick due diligence from a time and cost perspective.
Very practical insights, Vaibhav. Thank you very much. Moving on to our next question. How can advisor balance maximizing valuation while ensuring a smooth closing?
That's again a great question. So valuation, Sumbul, is very critical. Even before we do the deal, there should be a valuation construct already prepared, a valuation model which takes into account the forecasts, takes into account how the business is going to grow, a proper business plan approach, saying that if we are at 100 today of revenues, whatever the 100 may be, here is how a 3 to 5 year growth canvas looks if I'm raising capital. From an investor lens, they have to see scale, they have to see a path to profitability if it's not profitable today. And there should be realistic timelines for each of these. So from a closing point of view, one can maximize value if the whole process is done in a good time frame. There cannot be any dragging momentum. There could be COVID 2 and COVID 3. There could be tariff, geopolitical situation. They'll all kind of drag. So the efficient closures get maximum value. Then, the deal structures and the deal construct, one should have a good flexibility. Now, value maximization is a function of how the bidders will look at how you've thought through the pricing. What is the earnout structure that was thought through? Is there a availability of the management team to kind of smooth sail the business? There is, when a buyer is negotiating an earnout, he definitely believes that the business needs you for at least for some time. That's the time when I think it's important that the mix of cash and a earnout equity model can help a lot. Sometimes even cross equities help because then the confidence level is different. So having a flexible deal structure and a deal construct helps. Finally, one of the most critical factors in value maximization from a smooth closing point of view is relationship building. So keeping negotiations firm but collaborative. You don't want to burn bridges. You don't want to kind of have a situation where you win a small argument, but you lose the battle because somebody will keep a grudge. So, negotiations should be firm. There should be ZOPA, zone of possible agreements for valuation. But within that, I think courtesy, collaboration, respect, and then have a balanced view to closing. Sometimes one may have to give up a couple of percentages of valuation. That's fine. But ultimately, you want to be a happy deal and a happy engagement. And that's where a willing buyer, willing seller conversation should always be in a balanced kind of manner. That's where we have seen maximum value maximization can kind of happen in terms of a closing.
Very right, and very insightful discussion and points, practical points that you have put to limelight. Vaibhav, now moving on to our next section, which is ideal time to raise capital. That's very important, even for the firms who are working on the buy side and obviously for the sell side as well. What are the key signals that indicate a company is truly ready for fundraising?
I think that's an easy one, Zumbul. I think there should be a proven market fit. Clearly, the product market fit, whether it's a service product or a productized service, there should be clear demand, validated demand. So the market should be willing to accept and market should have accepted the product. That is an important time to then go in the market to raise capital. Scalable processes are important because one can't just grow businesses without systems and processes that can handle a growth surge. People, we have had this example of Shark Tank episodes. People come on Shark Tank, they suddenly get a surge of orders. They have closed a deal, but they are not able to fulfill the demand. Now, that's not a good sign. You will throw away customer. They will not come back the second time. So readiness is important. Then one should have a clear use of funds. Investors don't like a general growth, a general corporate purpose argument. They like to have clear use of funds. They want to make sure that you have, as a founder, where your funds are going to be deploying. For example, technology spend, market spend, people hire, new expansion, new capacity building. So there should be a very clear estimate of how much funds, when, and where. I think that depicts a lot of clarity and that builds confidence. Finally, I think I would also say the right time, the founder's bandwidth. Raising capital is a full-time job. Team should be able to run the operation. The founder should be available for investor calls, investor meetings, for discussions, and it does draw away a lot of time and effort from the day-to-day business. So the bandwidth of the founder is very critical when you're timing the fundraise. So these are the 4 or 5 things I would say, but product market fit is the key.
Yeah, right. Vaibhav, how do you think that does market timing influence the success of a capital raise?
Certainly it does. Now look at today's time when, there are geopolitical instabilities worldwide. Correct. The regulatory climate is uncertain. Currency movement is challenging. So there are macroeconomic headwinds that could create trouble, and one may not be able to close the IPO or even a fundraise or even a sale quickly. Because remember, investors are also very foggy. They are not sure. They don't know what will work and when. So timing is everything. So clearly, you want to be raising money when going is good, when a lot of optimism around. Interest rate stability is critical. Industry sentiments are positive, right? If sectors which are doing well and they're growing fast enough, you can raise capital as much better valuations versus sectors which are dying out, they're not growing well. This all, and finally, I would look at public market trends very clearly. How is the IPO market? How is the comparable, fundraise activity across sectors? That impacts private valuations as well. So clearly, cost of capital argument, risk appetite, all of that is a function of the market timing. And one should really time it well. It's okay to postpone by a few months as opposed to go in a market which is so uncertain where you will get very low valuation and even then the deal may not close. So timing is everything.
True, agreed with the fact. And Vaibhav, what are the risks of raising too early or too late? What do you think about that? Are there any risk involved if the company is going for the funding too early or maybe too late?
Raising funds too early, Sambul, could mean that you're diluting before the proof of concept point. So you're diluting too much. Or you may misaligned investors. You may have early stage investors, whereas your business needs growth stage investors. Versus if you're diluting too late, you may have missed some growth opportunities. You maybe then have a distressed kind of a forced raise, which doesn't give you again the best investors or the best valuation. So I would say the best practice should be a balanced raise. Ideally, when I have 12 to 18 to 24 months of cash runway left, and when it's a good time, everything that we discussed in the past, and when you're really ready to deploy, not just collect money in the bank and then deploy later. I need the funds. I'm now 12 to 18 months of my cash runway, and now I want to grow. I should go out and hit the market. And remember, it's a 3 to 6 months process. So my student will plan ahead of the curve.
True, agreed. Okay, moving on to our next part, which is investor pitches, do's and don'ts. Very important that how we can actually design an investor-oriented pitch. So what do you think, Vaibhav, are the top 3 things investors look for the first 5 minutes in a pitch?
Top 3 things in the first 5 minutes. I think first is the team credibility and passion. Why you? Why this founder? Okay, that's one. Second, I would say problem worth solving is the size, the urgency, and clarity. Yes, a lot of problems have to be solved, but is it really worth spending that time of efforts and putting that kind of money behind this founder for this problem? So, in the size of the problem, therefore the market size, the urgency, and the clarity with which the founder presents that this is how he's going to solve the problem. And the third is a clear, simple business model. How is money going to be made and how the business will scale? I think the founder should be able to explain that very quickly. So you don't need a lot of complex jargons. There should be simplicity in the pitch, and the business model should talk about very easily. Even a layman should be able to understand how will money be made and how the scale will happen. So I think if you look at team credibility, if you look at a problem which is really worth solving, and clear, simple business model, these are the 3 things that in first 5 minutes, investors would be happy with.
True, and very well mentioned. Yes, that how you are positioning your business and with founder perspective as well. Vaibhav, if we talk about the common pitch mistakes that instantly weaken credibility, what do you think are those mistakes?
Exactly converse of the first 3, the right things. The not so right things or complete mistakes and avoidable symbol would be overblown projections. In Excel, you don't want to have hockey stick growth just to show good valuation. Doesn't work. Nobody accepts it. Then, a lot of buzzword, lot of jargons being overused. So AI powered, blockchain, metaverse, you don't have to use this heavy terms. Investors see through it. If they don't see a compelling narrative, they'll discount all of that. And, dodging some tough questions. See, it is investors' job and their team's job to ask you the tough questions. It is better to admit that I don't know as opposed to bluffing an answer. That weakens the whole credibility. So these are the 3 things I would avoid. Don't have fancy projections, no fancy buzzwords. Don't dodge the tough questions. Say, I don't know. I know this, but this I will have to get back to you. That's a safer, better answer to give. One should never bluff their way through to the investor. It's okay to sell, but not to bluff.
Yes, very rightly said. Okay to sell and not to bluff. Agree to this fact. Very well mentioned, Vaibhav. Moving on to our last question for the podcast series for today regarding the investor pitches. How do you think can founders make their pitch memorable without overcomplicating it?
I think it's all about storytelling and the narrative. One should bring the problem to life with a relatable story and real anecdote. Investors love to connect to an actual story and actual anecdote as opposed to a lot of jargons and a lot of slides. Second, there should be one killer data point, one metric, which the investors really lean in. They say, yes, this is value. So, for example, same-store growth rate. Now, what is a monthly same-store growth rate? Now, the metric has to be very well defined and then explained with numbers. And then I would say, leave them curious. Leave the investors curious. Create a hook for the next meeting. Get them asking for more. Don't close everything. You can't close everything in one meeting. Just give them enough bite that these guys make sense. Let's deeper go back to the IC. Let's evaluate much deeper, because this is a business which is worth looking at. So if you summarize everything that we have said, Sumbul, some of my closing thoughts, whether you are selling a company, whether raising capital, or whether one is simply positioning oneself for future opportunities, I think the principles are the same. So you prepare thoroughly, okay, communicate clearly, and stay focused on the long-term value, not just the transaction or the deal in focus. I think these are some good practices that should work well for everybody in this business.
Very true. And here I would like to mention, since you are also the chairperson for the corporate finance, AG corporate finance community. So I remember that we also got this wonderful one-pager template in which very rightly said by you that do not provide all the information to the investor, because that actually creates curiosity. The template that is being designed by the committee in that way, that we provide a little bit information for everything, and that is just one pager and very briefly designed. Thank you very much, Vaibhav. We have covered so much for today, from unlocking value in the M&A to sell-side best practices, the right timing for raising capital, and how to pitch to investors effectively. Thank you for sharing such clear, actionable insights with our listeners. And we hope, listeners, that you found today's discussion both informative and inspiring. Don't forget to follow AG Corporate Finance podcast for more conversation with leaders shaping the future of business and finance. Until next time, I am Sumbul Samin with Vaibhav Manik, Country CEO, KNAV India. Thank you for listening, and see you in the next episode.